Man, that'll wake you up.
I saw this thing that we need to do, and basically you can take some of these like AI models now, and you can just like hum whatever like little vibey tune you want into a microphone, and then it'll take it and turn it into like a full production song that's custom for you.
Oh, that's legit.
And I'm like, oh, we mean let's do that. That's our new intro song.
Do you think you know a bit about AI right now?
No, nothing.
This guy's being a massive nerd on AI the whole
Such a
time.
nerd. Gonna buy a Tesla so I can code and have the car drive me around all day.
I mean, that's actually a segue into what we're talking about today.
Yeah.
Because one of your things about that is price of gas, right, with a truck.
I mean, I brought it up in the car with my kids the other day, and I was like, just saying this out loud doesn't mean anything to you guys because they're 8 and 4, but this is the highest gas price I've ever seen in Oklahoma. I mean, I can't remember another time.
How is it? It cost me like $120 to fill up my truck the other day.
Yeah. I mean, I think it was enough to where I noticed, I was like, it
sucks.
I haven't really thought about it.
Everything seems super expensive right now. And I think affordability is something that's really cognizant. It's interesting. We were in a meeting the other day with some of our agents, and Garrett said, we were talking about how everything's gone the first 4 months of the year. And he made a really interesting observation. This is the only time in his career he can remember not having any clients he's working with in the 300 to 700 range. Everything is either above it, so typically people that are potentially insulated by major economic changes, right? Or it's below it where people are having to do something real estate wise now in their lives because either they've got married, they've moved to town, they're trying to buy their first house, their lease is up in their apartment. So he was saying there's no middle ground, which kind of makes sense because you and I saw a chart yesterday that 50% of Americans have a mortgage rate below 3% right now.
Right.
Which is a massive shift, by the way. It was considerably higher than that last year. But life happens, right? They talk about the 5 Ds in real estate: death, diamonds, divorce, degrees, and I can't remember the fifth one, diapers, babies.
Yep.
So those life events still happen, right? People still get squeezed, but what we're going to start talking about today that's interesting is this study from Realtor.com that talked about how down payments have dipped in this first quarter of 2026. And it's, average, medium, income dependent and those kind of things. But the bigger picture about this really we're thinking is that because things are so expensive right now, cash on hand is tighter for buyers, right? What are you seeing with your clients with everything right now that are out there looking?
I'm getting a lot more question about closing costs for sure. And what does that look like from a negotiation standpoint on both sides of the transaction, on the buy side and on the sell side, where, even sellers' expectations, I'm starting to at least say, hey, listen, we're starting to see this happen more commonly again, because through COVID, asking for closing costs was like,
you ain't getting the deal
for real. No. How about
it's going?
You just buy my house now?
Yeah, these are the terms,
or you're gonna miss.
Yeah.
So that changed a lot, and slowly, I would say it's kind of crept back into the conversation to now where, like, at least when I'm consulting with a listing, I'm like, hey, listen, affordability is a real issue for people. When you start to run the math backwards on the buy side, it makes sense for a lot of people to keep their cash on hand.
How do you prep them? How do you prep a seller when you talk? You said you're getting both. So let's go through the sell side first. When you talk to a seller and you're talking at that listing appointment about closing costs and things to be aware of, what is it you're telling them?
So what I'm trying to do is set an expectation that you're still not going to pad your listing price, right? Because that's also anti-affordability, right? Like, you're not going to go catch some crazy number that's unrealistic on your list price. So first off, we're going to price appropriately. But inside of pricing appropriately, what that means is somebody's probably going to come in and they're going to ask for a portion of closing costs, especially outside of the luxury market, right?
100%.
They're going to come in and they're going to say, I would rather keep my cash on hand. The flip is the way, at least the way that I've always run the math, and mortgage lenders, feel free to correct me here. Some generalized math was that, there was a certain dollar amount for every $1,000 you change your sales price.
Yeah, I actually looked at this for a client yesterday. He wanted me, he's on the sell side. It was $35 every $5,000.
Every $5,000
on the buyer's monthly payment.
Yeah, so $7.
Correct.
Right. So it's not a crazy number, but when you typically run the math out on, let's just say you were going to ask for, 10 grand or 5 grand, the amount of closing costs, you don't like, it doesn't actually change the math that long, but typically the break even's like 10 years. 10 years.
Oh, yeah. Meaning of keeping your cash on hand, what you're saying. So having a slightly higher mortgage payment.
Yes, to keep the cash on hand now in the inside of their transaction and inside of your move process and all that stuff. It's a 10-year break even. And we know the stats on how long people average stay in a house. And it's like, it's not a real game, but if you're thinking about it just in the context of like this little bubble of a conversation, you're probably not staying in the house long enough, right, to have paid back, the higher amount. So you should just keep your cash on hand and finance your closing costs.
First time home buyers for sure always are going to want to do what they can to keep cash on hand. I think that's fundamental, right? Because you're buying your first house. The chances are this is the most expensive thing you've bought to date.
Yeah.
So keeping cash on hand is super important because you never know what life's going to throw at you, or if you're going to want to do stuff to the house or something breaks in the house, because now you own it, right? There's ways to kind of mitigate risk, warranties and stuff. Mm-hmm. Are you having any clients that have brought down their interest rate right now?
Yeah.
Can you explain what a buy down on an interest rate is? Just give us a synopsis of that from a layman's terms.
Yeah. I mean, think about throwing cash at the problem to make the interest rate lower. It's as simple as it gets. And so basically what you're able to do is capitalize on, again, this is it's not necessarily a cash up front affordability strategy, but you can go ahead and buy down your interest rate. Now there's other ways you can do that. The way I'm talking about that doesn't match the affordability situation is you're going to spend more of your cash, right, to buy down that rate. Unless
go ahead, whose cash could it be?
You can get some sellers incentivization there, right?
So that's a massive thing. So one of the things that people really need to pay attention to right now, and a big mistake buyers are doing, is they're trying to go, well, I know no one's buying this house right now. I'm going to come in and offer 25 grand less. Mm-hmm. What may be a better position for you, and what you should consult your lender on, is maybe you're better off taking, instead of trying to go 25 grand less, asking your lender, hey, what would 15, 20 grand do to my interest rate if I buy it down? Because we plan to be here long term. Mm-hmm. And if you can lock in a longer rate long term that you feel comfortable with, and it makes sense on reducing your monthly payment until you may refi in the future, whenever that may be.
Yeah.
Right? Because we're still told, we were on a call yesterday, we alluded to it. They said rates still are projected to go into the low sixes before the year's up. There is so much going on a global level right now that was not predicted in January that I don't really know if that's
it's hard
viable.
to know.
It's hard to know, right?
Absolutely.
So you have to do what's best for you in your current situation. And if that means using some money to buy down your rate as opposed to getting a lower purchase price on the house, that's a way better position to be in.
I'd be curious to know, again, from mortgage partners that we have, I can't imagine that there's not also a spike currently with the affordability issues that we have in some of these lower down payment, loan programs. Meaning,
because people aren't flush with cash, they're going in and getting a lower loan.
FHA, definitely capitalize on your VA. Let's go even USDA. We'll move further outside of the city and capitalize on some of these, 3.5, 0.
Explain why someone would choose FHA over conventional right now. And FHA, by the way, is not first time home buyer program. It's a federal housing authority loan.
Yeah, so typically, right, the cash on hand. There's a misnomer, a massive misnomer. First off, in the lending community or in the consuming community, that you have to have 20% down. We've talked about it before on the podcast. You don't have to have 20% down. You can actually even put down as little as 3% down on conventional financing. Now you're going to get clipped some other way. There's some negatives that come with it. Mortgage insurance is one of them.
Higher interest
rate. Yeah, there's some balancing act there, right? But you can do it. Traditionally, in the last decade, since I've been in the industry, there was a period where your mortgage insurance for not having a 20% equity position in your home, that actually was something that you could get an FHA loan, put 3.5% down, build equity in your house, and then make a phone call when you hit that 20% equity position, and then your PMI would disappear. And then probably 4 years into my career, that the federal housing side of things changed, and it said it was no longer available to do that, right? So it became a little. This was when rates were really low, and
So
conventional
what you're saying
loans.
is the difference, real quick, just to make sure we're clarifying, the difference between a conventional loan and an FHA loan is an FHA loan carries PMI, private mortgage insurance, for the life of the loan, regardless of equity in it.
Yep.
Whereas a conventional loan, once you go beyond 20% equity, PMI falls off your payment schedule.
Correct.
Okay.
And while rates were really low and very competitive and very similar between both of those products, there were even periods of time where it actually made more sense for you to go, to the FHA side of things, just because of how the loan structures were. Once that flipped, it became a far less competitive product. And then as rates began to climb, things like that, not as many people leaned into, if you didn't have the cost up front issue, if you didn't have cash out of pocket as an issue, everybody went to conventional, right?
Yeah.
So I could see this being a strategy for a lot of people, which is like, again, we're talking about how long somebody's in a house. It's like, if you're not in a house for 10 years, you may not make it to that 20% threshold. If you're going to be in a house 3 to 5 years, then take the FHA, keep your cash on hand,
Get a lower interest rate.
get the lower interest rate. Yeah, exactly. And then utilize your cash to go do whatever you need to do in your lifestyle,
Just have it in the bank, be safe with it. The other thing,
or invest it.
So speaking from personal experience, I mean, this is what my wife and I had to do when we bought our first house. We weren't the conventional loan was not a smart option for us to go at the time. We knew we wanted to get into the house. We didn't want to wait. So we got an FHA loan to start with.
Yeah.
And we refinanced out when the timing was right into a conventional loan. And it was the right thing to do. So you can always refinance. I think the other thing people aren't aware of is, like you touched on it, as little cash you can get into. Like we're going to get back to a phase, I think we're headed there now, where you're going to have people close on houses who haven't put any cash into the deal whatsoever up front. They would have had the seller covered their closing costs.
Sure.
They may have got a down payments assistance program. I do think you're going to see more people buy down rates because they keep getting told rates are going to come down and they're not coming down, but they have to move. So what am I going to do? Instead of trying to get the house 10 grand cheaper, I'm going to try and get 10 grand and put it towards my rate buy down. We're seeing also, you have to bear in mind, right? We talk about this all the time. Houses are the inventory. And when your inventory is not selling, you need to make it desirable and motivate people to do so. If you're not writing mortgages, you need to make them desirable to do so, which is why you're seeing Tabor Homes are now in Tulsa. They're doing a development in Broken Arrow, Whiskey Ridge. We have 12 of the houses listed for them, 40 plus lots available if you're interested. They were running a special this weekend. It was 3.9% year one, 4.9% year two, and 5.9% for the rest of the life of the loan.
Yeah. So that's a 2-1 buy down.
That's an insane opportunity for someone to hold like that. I mean, that's just a phenomenal opportunity to custom build a house. And so this is what you're seeing people are doing. The smart builders are thinking about these things and they're trying to get people to come in and entice them to do that. And I think what you'll start to see is, again, more sellers, when they're negotiating, have to do things like this.
Yeah. To me, some of those like buy downs, what I like about them, there's an underlying assumption though that could easily be missed though, which is, hey, you're gonna buy your rate down, right? So you're gonna have some temporary feeling relief before it changes back to more of a industry regulation, or a standard industry norm, right? And to me, I think the underlying assumption is, yeah, and in that meantime, what you're gonna do is increase your income, right?
Life changes. Yeah, I saw this. There was I watched a video yesterday of a lady on Facebook talking about recent graduates and preparing for financial success. And she said financial appearance and financial stability are not the same thing. She was talking about social media.
Sure.
And what she was saying, the other mistake people make is what you just said there. When you get your first job and you buy your first house, you fully expect your income over life to increase. We have a guy buying a house right now who's like 25 in financial advising at 25. His client basis will grow without a doubt. It's just what happens when you survive in that industry. So his income is going to improve. So he's got a mortgage right now that when we talked to him about it, he said, it's a little more than I wanted to spend. He's a smart guy. He's about 16, 17 grand more than he wanted to spend. So going off the math, we talked about maybe 140 a month, 130 a month more than he wanted to be paying, but he can still do it. And he has the foresight to say, I'd rather lock into this house now when there's less competition as buyers and get this property. Because I know that if this market was hot, I mean, he's buying in Florence Park. If the market was hot, he's like, there's no way we're getting in this without competition.
Yeah. Well, I think conversely, like if you don't meet the underlying assumption that I'm talking about, it's like if you don't come in and increase your income, then really what you did was you bought a false sense of security for yourself for 2 years, you know? And the reality is you're going to have a 6% interest rate and you need to be comfortable with it. And so if you're not going to go out there and like, you know, increase your, you know, your income level, then at some point I also think it could backfire. And it's like, well, great. What that does is it's going to create a lot of, I need to sell because I'm not in a good spot because I don't have the cash flow, and you know, we're going to have problems with it. So, and I think, you know, I think that some of that is consumer decision making. Some of that is like are the lending programs that we're putting out here for relief in reality, are they good? Right. And so I think, you know, even it was talked about a little bit on the call yesterday. We didn't go into the weeds at all, but the question was, or posed at least, that there is some potential sort of, you know, bailout or, you know, incentivization.
They're talking about maybe in the $9,000 tax credit of 2008 potentially being something they're considering, try and motivate people to buy again. But I don't think that necessarily solves.
It doesn't. It stimulates
affordability. Yeah, it's temporary.
It stimulates, but it doesn't necessarily help the affordability issue at all.
Yeah.
What you've talked quite a bit about the affordability issue. You know, where do you think the biggest press points are on it right now? Like, what's the biggest pinch? Is it a cash thing? Is it a cash flow thing? Is it just a housing price thing? Is it a combination of all of it? Is it, you know, where do you think you see?
I think
the
you have a
biggest
combination of everything. I think macro economy at large, like we said, when gas is north of $4 a gallon, and we're lucky Oklahoma's one of the cheapest states, right? You're getting pinched there. The other thing I think is like cost of building materials. They've not gone down, right? COVID, those prices, they found out people are still going to pay it. They're going to keep charging you for it. They're not going to reduce it anytime soon. So that's the other thing to be aware of, is like cost is expensive. Then you take into account we're short something like 3 million homes in America, right? So the cost to build the homes with the materials is expensive. We have a shortage of it, which means there's a demand and limited supply, which typically means increased pricing again. So the way it's going to force itself naturally as an economy is prices are going to rise. But what I think could happen, and probably should happen, is builders should consider completely scaling back the size of the product. And I mean that dramatically. Like, I would be curious to see if one of these, like these track builders you get in like DR Horton, Simmons, these guys, what it would cost them to build a 2-bed, 1-bath.
Yeah.
Because you would have first-time home buyers. You take Alejandro, if you could buy your first house and it was a 2-bed, 1-bath, and say it was 900 square feet, 1,000 square feet, and $200 a month more than you're paying mortgage, would you buy that house?
Definitely.
Yeah. See? So I think there's a whole demographic of person out there that if you built a community where everyone knew, and you don't have to do it like 40 acres. That's the thing. You go do that on 5 acres.
Yeah.
They're all going to be similar generation in life. People don't need these massive houses. So when you're looking at someone and going, oh, our only option is a 1,800 square foot, 3-bed, 2.5-bath with a 3-car garage.
Yeah.
Well, if I don't want that, he's a single guy looking to buy his first house. He's not trying to do that. He just wants to get on the property ladder. So unfortunately, I think they're going to the product's going to have to change.
Yeah. Yeah, it's interesting.
It's not going to get cheaper.
It's not affordability, but I think another interesting pressure that's coming, I think, in the luxury market to some degree is, you know, during COVID, we had a lot of, you know, professionals, you know, high income folks. They got into great big properties that they made the move up during that time frame. But I know a bunch of them that like they did ARMs, you know. That 5-year arm, 7-year arm.
And now like, that mortgage is coming due.
Yeah. Well, it's like, it's coming back to really most of them. What they do is they go to a prime plus, you know, the prime rate plus a point or 2 points, depending on, you know, who they're with, where their loan is getting held. And to me, I think that's interesting because that creates its own pressure where somebody says, all right, well, since COVID, the property's increased in value, so I have more equity. but I've got this loan scenario issue coming up. Should I stay here and just refi and reacclimate to my new rate, right? And set that thing on a 30-year fixed note or 15-year fixed note? Or do I actually capitalize on the increase of my, equity?
Yep.
And do I move now, right? Maybe I'm not even moving up or down. Maybe I'm just moving again laterally because I've got an event happening in my life, which is I have to make a decision on whether or not I want to refinance and recast what I'm going to do financially for this house, or do I just take this opportunity to move into a completely different one?
Yeah.
And I think that's happening to me, the luxury market is cruising right now in Tulsa. It is doing way better than I've seen it do.
People also buy real estate to hedge against inflation. So, look, I need to wrap this one up because I got to run to a broker's open right now.
Great problem now.
It is, yeah. Got to go out there, give away to Cova's gift card. Well, next week, let's talk about sellers and some of the mindsets that you need. We talked about buy side today and affordability, but I think talking to sellers about what you need to do to sell your house will be a good talking point for next week.
Sounds like a plan.
All right. Appreciate you.